Hello, everyone. Welcome back to another episode of Let's Talk Housing. My name is Brennan Thomas, and I'm the co host here alongside Stephen Thomas, chief economist and founder of Reports on Housing. Today, we will discuss the most recent economic news and statistics because so much has happened in the matter of like a week. The spring market, dropping mortgage rates, first time home buyers, home values, and so much more. But first, again, like usual, Stephen, what is going on in the Thomas household?
Yeah, boy, lots happened over like the last couple weeks. And basically, you left, and so it's been a you were gone, and I basically was left to hold it all together with Matt, and that was a lot of fun. So I was burning it from both ends there for a while. Totally value what you bring to the table, but as far as what has gone on with us, the Thomas household track season is underway. We like our soccer. We love our track. I know that you love soccer, but now we absolutely loved the season of running. I am a cross country runner. My wife is a track runner, and it is track season. And my wife is very, very happy. She even helps volunteer and runs these track events. So we had our first track invitational last Saturday, and then we had a dual meet this week as well on Wednesday, and then there is another track meet going on tomorrow where our daughter will be running a 2 mile, and she is doing so awesome. We think that, hey, you know what, that'd be great if she could do something pretty incredible, but her goal is actually to break the school record for the 2 mile. So that's where we're at. We're in track season. Zeke's basketball season is done. And so he's going to try out for another basketball team this coming up week. And Mason, that's rounding out whoever's here left at the home. We have four. Mason is definitely doing soccer, and he has his first game tomorrow. Athena's also doing tracks. We have Alana and Athena both doing track at the same time. Athena's a freshman, so she's just trying to figure out where she belongs. She's done the 800, the 400, the 200, the 100, the 4x100. So we'll see where it all falls for her. So that's what's going on over here. How about you? What's going on in your neck of the woods there, Brennan?
Yeah, I mean, like you said, I was in Hawaii and it was an absolutely amazing trip. It was so relaxing and just what I needed. My first vacation from what felt like years. I guess my last vacation what was like COVID, like like laying down all day, all huddled inside, but it was absolutely beautiful. The weather is beautiful. It was absolutely unforgettable. And of course, it was perfect weather every single day, just 80 degrees, sunny. Um, got really nice drinks, good food. It was a amazing time. Thankfully, not too burnt too. So I learned my lesson of being there last time and bought so much sunscreen to the point where we were running out. So it was
That's good.
a good issue to have. But outside of that, it's been pretty much the same. Just readjusting, being back here. I definitely missed it, even though I was gone. It was something I was still looking forward to. Um, just being back here, and all of a sudden, like as soon as I get back, mortgage rates just started tumbling. I don't know if I need to like go on another vacation so it can go down to like 5%, but like, um, it was amazing to see. At least it was a good positive to come back to see. Um, hopefully that will be here for a bit, but yeah, just to kick off this episode though, Stephen, what have you seen in the past couple of weeks with supply, demand, and our very own expected market time?
So yeah, so what's going on with supply is going up at a pretty decent clip compared to the last couple of years. It's going up at more a faster pace, and that has a lot to do with more homeowners coming on the market. than last year. We've talked about this before. 2023 was home to the fewest number of homes coming on the market because we were adjusting to rates going from 3.25 all the way up to over 7%. And then, there weren't that many homes that came on the market that year. A lot of people just decided, I'm not moving because I love my fixed rate. And in 2024, we started to see that thawing out a little bit, saw more homes coming on the market than the prior year, still well off of where we were prior to the pandemic, where averages are typically the same on a month-to-month basis. And then, but now it's been such a long time since we had rates that were lower than 6%. It's been, as of this coming up week, 31 months. So we're recording this on Friday, February 28th, and we're about to hit March. 31 months ago is August of 2022, the last time we had rates that were in the fives, and it was the start of August of 2022. So we're about to hit 31 months ago, and that's a long time. So more and more people are believing that rates will never come back down into the fives, and they're just tired of waiting. So we're seeing even more homes come on the market. And there are also more homeowners that are getting in a pickle. There's a lot of people across the United States that bought homes from builders with 3-2-1 buy downs or 2-1 buy downs. And as a result, what they were thinking is that rates would eventually fall so they could refinance, but that has not happened. And in some cases, it's even higher than where they were before. So they can't necessarily refinance into a new rate. Now they're stuck at this prevailing rate that's a lot higher than where they were over the last year, over the last couple of years. So they've been stuck at this higher rate now, and a lot of them, since they can't refinance, are turning to selling. So we're seeing some movement there as well. So it's just mixed. There's more people that are coming on. They're tired of waiting. They want to do their thing. So we're seeing inventories rise. Now, demand levels have been very, very similar to last year. And it's funny because we do demand levels for these Western markets like SoCal, the Bay Area, and Phoenix and Vegas. And this pending sales index is not necessarily showing in the data that we're looking at. We're looking at year over year, slightly above if we put all markets together than where we were last year, just a little bit. But now we have rates that are different than they were last year. They are lower than where they were last year. So it's going to open up demand, and we just got here too. So it needs to be here with duration. And if it's here with duration, we will see more pending sales activity under contract homes. And that will change the whole market dynamic. So it's something that we're watching closely. So if we have demand that's going up at a little bit higher pace than where inventory is going up, the market is getting just a little bit better from a couple weeks ago, just a little bit. And now it's getting to the point where we're going to get to March, and it's actually going to bottom out. And then we're going to see that there will be more homes coming on than demand, and we'll see the market continue to slow unless rates continue to drop. That's the big caveat.
So kind of like we talked about, I came back and mortgage rates all of a sudden just tumbled. The day that I left, it was 6.96, and I was like, all right, we beat 7%. But when I get back, I mean, we are decently into the sixes, and I'm actually quite surprised. So I had to give you a call, of course, and get caught up on what happened in literally just a couple days. But can you catch our listeners up on what happened with rates and as far as economic data goes?
Yeah, it's fascinating to watch that. We saw that rates dipped just below 6.75 at 6.74% as of today. But we haven't been here for a while. This is nice to finally have these rates here. And the whole reason behind me wanting rates to come down is the whole housing market has been frozen. That's just not long-term healthy for the United States. And we'll get into some of the other questions that you have for me. And a lot of that has to do with rates being stuck above 7% for such a long time. This is the first time that we're actually getting cooperation of rates that's coming right before our spring market. So this is a really good time for rates to drop a bit, because it'll set up a better spring than had we remained above 7%. So there's not been a tremendous amount of economic news other than today was the personal consumption expenditures index that the Fed likes. That's another version of an inflation gauge, kind of like CPI, Consumer Price Index, that gets all the fanfare, but it's not the one that most economists like to point to, and especially the Fed. Their favorite preferred one is the one that came out today on Friday, February 28th, and that is the personal consumption expenditures. It always comes at the end of the month, and CPI comes in the middle. So everybody gets this idea of what the way things are going to go. But consumer price index, it just doesn't have as good of a mix of goods as personal consumption expenditures, and it also doesn't personal CPI has too much weight and shelter, and the shelter component is a little bit backwards on some of the parts to it, and it's very laggy. And in personal consumption expenditure, it's not as big of a part. So, and peeling that apart for the one that came out today, which is extremely important, we'll go to that one first. And that was actually right in line with expectations. It wasn't higher than expectations like consumer price index. So it came in where it needed to be. And that's after things were recalibrated with some of the reports that we had on manufacturing inflation behind the scenes. It pointed to a better PCE that we got today, and that's after they recalibrated their expectations. So now it's in line with those expectations. But within the last week, what's really happened is this overall sentiment. And the sentiment, there are two different sentiment. One is the Michigan sentiment index, and it's a survey that they do. And then we also have a consumer survey that comes out this week. Now, they both had a noticeable drop in sentiment, and the one that came out, Michigan's survey, also looked into what everybody's inflation expectations, and it shot up. So we have, and this was a pretty big drop, and it's not necessarily just on party lines. When you peel everything back, it looks like there's definitely some concern based upon the current trajectory of where the Trump presidency is going. So the presidential administration with the tariffs, it looks like they're going to work with these tariffs rather than tap dance around them and use them as just negotiation ploys. So there is to be some more stickiness. We heard that, and this coming up week. It's March 4th, where the tariffs are going to be they're going to be 25% in Mexico and Canada, and I don't know there has been no communication as what they need to do in order to bring to make sure that those tariffs don't happen. So we'll see if that's punted further. But they also announced that China is going to go up from 10% to 20%, and I believe that is at the beginning of April 1st. And now there's talk of European tariffs. So there's all this different tariff talks, as well as all the different firings that are going on, and it's affecting all aspects of everything that's out there. It's starting to go into the ecosystem of sentiment, as well as there's a lot of there's a lot of uncertainty as to what they can actually plan for. So a lot of planning is being put on hold just to see how this all works out. So that's beginning to take hold within the economy. And right now, as far as GDP tracking is concerned, GDP is coming in right at 1%. So it was at 3% last year, and now is down to 1% for the first quarter. So this is kind of a different feel that's out there. And then we had initial jobless claims that came in on Thursday, and it was a surprise to the upside. It was a lot higher than expectations. And initial jobless claims is something that we watch in economics land because it comes every single week, and it gives us a good taste as to where things are going. It's not yet at a point where it causes us a lot of concern, and that was just one data point, but it also came this week, in the last week of February, when everything else is going on. So as a result of a lot of this uncertainty, we watched, and that consumer sentiment, as well as the different things that the administration was saying, on last Friday, we had a big giant drop on Wall Street. And then this week, the whole week it's just continued to be a drop on Wall Street. So there's a lot of volatility. There's a little bit of negative sentiment on Wall Street right now, and a lot of that is because of the uncertainty. Business doesn't like uncertainty. They want to know exactly what the policies are, the directions are going, but they don't quite understand because the communication hasn't been there right now. So, but we're going to know more as things go forward. So we're going to see how now a lot of this is sentiment and a lot of this is feel, but we'll have to see how it's coming in on the various economic reports that are coming and will come out in March. So starting with next a week from Friday will be Jobs Friday. Now, a lot of the firing that took place recently took place after they actually lock in and they start really tracking it. So don't expect a big giant unemployment rate or the number of jobs created to be way down with that report. That's going to be like kicked down to the can till in April when they talk about March's jobs. But next week is important. It's jobs week, so we'll be looking at that as well. So that's kind of brings you up to speed. And we've watched because of the deterioration, all of a sudden there's an appetite for longer term issuance. And that's what we get with 10-year treasuries, as well as mortgage-backed securities, which kind of tied to interest rates. So what we're seeing is that there was an easing. We were stuck at a certain level for quite some time. That was right at 7%. And now you could see that there's been, it's started to come down with a bigger appetite for people moving out of the stocks towards longer term issuance. And now all of a sudden, longer term issuance is coming a little bit more in vogue. And we've watched rates come down, and now they're at 6.74%, which is the right direction. That was what our base case was, between 6.5% and 7%. We're getting there, and it's coming right before the very, very start of spring, which is actually like right here on our doorstep. So this could be really good for pending sales and demand. So we're just going to have to watch it to see if it continues so that we can continue to have rates that are below 7% into the sixes.
So next I wanted to switch over to the spring market. So I wanted to start by saying that this winter market has felt very, very unique, where all of a sudden supply is just surging and it's very different. It's not the same as last year. So as this market continues to evolve through its seasonal changes, is the housing market gaining traction as we are heading into the spring market? What can we expect of this year's spring market?
Yeah, we just have it's a different marketplace because of the buildup of inventory that we have. The inventory is way larger than it was last year, and that's because of rates being stuck at above 7% for most of last year. Not until it didn't really cooperate until we got to the fall. So those extra homes that were coming on the market were met with very, very similar year-over-year demand. So as a result, we had an accumulation of homes coming on, the extra homes coming on the market accumulated and created this inventory, and pretty much across all markets. So if you have a bunch of extra homes coming on the market, yet it's matched with very, very similar year-over-year demand, as a result, you're just going to watch that inventory grow. And that is what happened. We're still not placing as many homes as we did prior to the pandemic, yet it's moving in that direction. Many markets are reaching their pre-pandemic days, but for the most part across the United States has not quite got there yet. And so we are adding these extra homes, which is great for when rates do come down, which we're starting to get rates that are coming down. So we have these extra homes. It feels more sluggish this year compared to last year. It's just the overall arching theme. It feels a lot more sluggish. This means that as rates come down, we can see more demand. It will still go from being sluggish. It could speed up, but it would take time to speed up because there's still, on a monthly basis, more homes coming on the market. Those extra homes have to be eaten up. So even if we do get more pending sales activity, more closed sales, it's not necessarily going to totally speed up the market because there's extra homes coming on the market. So there's that extra seller competition. And if more homes come on the market, yes, more pending sales activity, more closed sales, but it's not going to heat up a lot. So I would not expect anything magical unless we really saw rates come down to about 6%. then we can start to see a lot more pending sales, and even we could see the speed of the market speed up further from where we're at right now. But at 6.75%, we're not there. Between 6.5 and 7, we'll do more transactions, but we're placing more homes on the market, so it won't be a noticeable change within the marketplace. So what you see is what you get. Be prepared for it, and so that's what. But it will be a better spring as far as numbers of pending sales are concerned. It's just the velocity will be a lot slower than where we were last year and the year before.
According to Yahoo Finance, they believe that this year's busy season may be slower than the previous year. So, can we break free from this slump from what it feel like has been since 2022? If so, at what interest rate could we now expect such a change, especially now as mortgage rates dropped, thankfully, to 6.75?
Yeah, I kind of already like tap danced around this in the last question, but that was basically that we're kind of there. That if we're at 6.5 to 7%, the market, we will do more pending sales transactions, but it will feel a little bit more sluggish. They're right there, but it will be a busier season. There will be more pending sales. There will be more closed sales, just by the mere virtue of it getting below 7%. Year over year, interest rates are better than where they were last year. And if they're right now 0.25% less, that's enough where it'll move the needle. It won't move it gigantically, but if the rates continue to fall, we get to 6.5, that will move the needle even more. So if you want to know what rate it is, it's as rates get lower. So 6.75, we're doing a bit more. It's just like pushing on the gas pedal. As rates fall, you're pushing on that gas pedal more and more. And it's below 6.5% with duration will be starting to move this economic engine called the housing market. You will see a massive thawing of the housing market. And if that happens during our spring market, it's going to be a totally different market. Now, we had forecasts, and it depended upon where interest rates were going to be. And our base case was 6.5 to 7%. Now, we were feeling after the start of the year and the numbers we were getting, it was going to be stuck in our other case, 7 to 7.5. But there is now a growing possibility that we go from 6 to 6.5%. That would be a gigantic change in the marketplace, and that's where we get some real thawing. It's a slight thawing between 6.5 and 7%, so that more transactions can take place, but it's not enough. We really need to get below 6.5 for it to really be a really good thawing. And a lot of people say we need to be below 6%, but we proved that when we were at 6.1% for a week. There was a big change in the data, and we were only there for a week. Can you imagine if we were at 6% for a longer duration? It's like you're pushing down the gas pedal and it's moving. You're out of the traffic. It's going. Finally, the traffic's over. What it felt like is it's just been too slow for such a long time, and that's because of where rates have been. So things can definitely change, but it's anybody's guess as to where we're going right now. But I think the base case between 6.5 and 7% is pretty plausible at this point.
So, on the topic of the Trump administration, could the presidential Trump administration be using the tariffs against Mexico and Canada and China to enforce rates to drop as they have previously requested from what felt like a couple of weeks ago? So, if so, this can greatly affect the markets, right?
I really haven't heard anybody within the political space. I'm not political at all, but we have to watch this because of the ramifications of how it affects things. Now, the end result of everything that they're doing has resulted in the choppiness in Wall Street, and then as a result, we've seen the flood away from stocks to longer term issuance like the 10-year treasury, and we've seen interest rates respond as a result. So that's something that he wanted. That is something that they're getting. But there's going to come a point where if the economy slows down too much, that something's going to have to give. I don't think that we're going to go as deeply into this tariffs thing, but we could possibly, because I think that there has been some talks within the administration that there might be some pain that we all have to endure in order to get through to a great patch down the road. So this could be some of the pain that they're talking about. And when there's pain within the economy, economy, what you see is that interest rates come down because now rather than play in stocks, that's overnight stuff. They want more longer term issuance, and that's why there's more of an attraction to bonds right now. But we'll have to see. Things can change in a dime, as we've known from the past, and so we will continue to watch it like everybody else is very carefully. But the Mexico and Canada tariffs are just that's just more of the tariff talks. There's also tariff talks that's coming up for Europe, and there's China as well. So you have to look at it all put together, because a lot of these companies, they rely on Mexico, which is actually the labor cost and everything else is starting to be cheaper than China. And that's why you're seeing a lot of relocation stuff to Mexico, and a little bit less reliance on China. So, and a lot of the automobile industry, they utilize, what was the NAFTA agreement back in the day between Mexico and Canada. And there's this there's kind of cohesive supply chain, and this can just definitely disrupt that kind of thing. So that's why you have to continue to watch this stuff to see what the ramifications are within the economic side of things, so that we can see ultimately what happens to 10-year Treasury, longer term issuance, and interest rates, which is what drives the real estate market.
So the National Association of Realtors said that only 24% of all of U.S. home sales in 2024 went to first-time homebuyers, the lowest share in history. So we are continuing to worsen over time from what the data lines show with first-time homebuyers. Is there any sign of hope, say for anyone around my generation, to get into housing as most people, of course, dream?
Yes, ultimately there is, and that hope is of course within interest rates. There are some areas that are taking it a little bit more on the chin. We've heard of them. There's Florida, Texas. That's why their values are coming down a little bit in those areas, because of how much inventory there is, and then still how cost prohibitive things are with interest rates where they are today. So the first time home buyer, it's the millennials and the Gen Zs have been taking it on the chin for quite some time, because they've had to deal with quite a bit. There was the big run up, interest rates come down. They had the pandemic, and now all of a sudden, nobody during the biggest demographic patch of first time home buyers are not able to purchase at the age of 31, because there's only a limited number of homes available, and everybody's bidding on the properties that were available. And the buyers that are more seasoned have more money in the bank accounts, that they've just sold their property and have a lot of money, and they've been a part of their job for a long time. Those are the people that have been winning for a while, and the higher FICO scores and things like that. So when it's survival of the fittest are the older generations that have been prevailing, leaving the millennials and Gen Zs behind. And you could see that in something else that NAR published. That's the median age of the first-time home buyer jumped. It's at 38 years. It was down at 31 years back in the day, and now it's at 38. And that jump has everything to do with it's the people that have been able to save more and have part of the ecosystem having more, maybe a little bit better credit, longer credit history, as well as more money saved up in the bank. That's why that's been elevating to 38 years. The only thing that really fixes this thing is either values cave, which we're not seeing, and they're not going to cave in those other parts of the countries that I'm talking about. They're coming down from their really high highs. But it's for prices to come down, which we're not going to see, but it's really rates to come down. Already a step in the right direction. 6.74% is not going to do it. 6% is where it starts to open up the door to a lot of millennials and Gen Zs that have been waiting on the sidelines. And down the road, if we're at 6%, and then we have there's this spread where interest rates like to be long term versus where the 10-year Treasury is. Right now, the spread is a lot larger than it should be. If we get down to 6% and then the spread gets better, all of a sudden we're at 5.5%. Now 5.5%. Now we can maybe get down to 5% down the road. Now we're talking rates that will allow a lot of millennials and Gen Zs to play. So we're just gonna have to see where all this goes out. The only thing that lingers in the back of my mind that I have an issue with is the fact that we're gonna see we see these rates that come down. now we're going to start eating into the inventory, and now we have an inventory problem again. So it's how slowly we make it down to it, but we've added these extra homes so that it won't be zapped up immediately. But if I was a millennial or Gen Zs, I wouldn't wait for rates to get too low. I'd get in as quickly as I could before rates got to the point where there's too much demand and we're back to the same problem of not enough homes on the market.
Absolutely, yeah. And to touch on that, at least from my perspective, is that I'll be writing an article going over affordability and the different factors that go into it, and that's income, mortgage rates, and housing prices. So, I mean, since 2020 alone, home prices have risen 51%. So, if you want affordability to actually work and for it to not deteriorate, incomes would have had to risen that same percentage, but they have not. It has been significantly slower. And we're seeing it at least with millennials, like you were saying, and Gen Z. The incomes, since they're not lining up, it's a vicious cycle. And it's been like this for a couple of years. And interest rates are what at least the younger generations can really rely on. But at the same time, demand is just going to pick up just as quickly. So it's going to be a patience game, and it's going to be whoever's actually ready to be in the market will hopefully get their foot in the door and get that home that they've been looking for. But I mean, as far as I can tell, it can't really wait in a housing crash. That's not in the cards unless you're looking at specific people on the internet, which of course there will always be those people. But I'd say just keep your hopes up, keep saving up money. There's different ways to get into the market, like renting rooms to family, to friends, anything like that. I'm not going to be the type of person that's going to put my head in my lap and just give up. So always got to be positive. But on home prices, at least, the U.S. housing market gained $2.5 trillion in value in 2024. So the combined value of U.S. houses climbed to 49.7 trillion in 2024, according to Redfin. That's absurd. So what can 2025 look like with home values now that we are a couple months in?
If we remain below between 6.5% and 7% rates for our spring and summer markets, you could see this continue to go up a little bit. I think that if they jumped back up to 7% and remained at 7% plus, you'd look at not a lot added to the year over year. It'd look very, very similar, not a big gigantic change. Now, if rates drop below 6.5%, you could see another big giant jump in the overall housing stock gain. So, like everything else, everything depends upon rates. That's just how the housing market engine has been working because of how cost prohibitive and unaffordable things have been for such a long period of time. Once that finally changes and gives, that's where you're going to see a change in the marketplace. And it takes the economic numbers to slow down. But remember, most people are going to be gainfully employed. And there's a lot of millennials, Gen Zs that have just been waiting on the sidelines and renting. So people think that, well, there's a slowdown. People aren't going to jump in. Sure, I'll believe it when I see it. What's really going to happen is all these gainfully employed people that have been waiting are just going to jump into the marketplace once rates start to become a little bit more favorable in their direction, which could be right around the corner. We'll just have to wait and see.
So to end this episode, I have to put a fun article in, at least for you and I, we find fun. So Yahoo Finance wrote an article saying the average home price in the U.S. is now $355,000, or actually 355, $328,000, according to Zillow. But in some markets, it's much higher, of course. However, if you want to live in certain high demand areas, it could be worth waiting for prices to drop. So, Stephen, what are your opinions on waiting for home prices to fall in high demand areas? Can people be saying this due to what has happened in Texas over the past couple of years?
Yeah, they're looking to Texas and Florida. It's the stuff that gets the headlines. That's I wouldn't be sitting by on my laurels waiting for the market to all of a sudden crash. We have plenty of those people that make comments within our comment area that they think that we're just blowing smoke, and that's not necessarily what it is. We're calling the shots like it is. That's what we do. We're all about properly setting expectations. The problem with interest rates going down is it increases the amount of demand and eats into our inventory, and we already have real inventory shortage across the United States. So that's unhealthy. It's not what we're rooting for, but that's what the marketplace is going to do. So that's what we have to talk about. We have to talk about the realities of what to expect in the marketplace, not this is the best time to buy, this is the best time to buy. That's what I get accused of saying that all the time. I'm just telling you what it is. If you want to be a permanent renter and you're waiting for because you're waiting for the market to crash, then be that permanent renter. That's not what we're seeing in the marketplace. Other than those few areas, we're not seeing a crash. We're seeing it definitely come down. So that's what's kind of going on right now. And but so overall, I wouldn't be really waiting for prices to come down off of 355, 328. Shoot, I'm in Southern California, and I wish everything was 355, 328. You'd be buying a house right now today if it was. I would be like, seriously, I'd tackle you if you didn't. So, but that's just that's the difference of kind of markets when we're in SoCal, or now we're also doing the Bay Area. But anyways, that's kind of what I see. But what do you think?
Yeah, I mean, the topic is similar to waiting for mortgage rates to drop, like the people that will wait for presidential elections or will wait for Federal Reserve press conferences and the meetings. It's if you can afford going into the market today, it is worth getting in right now and to start building that equity and to actually start making money in that way. But waiting for home prices to drop and waiting on mortgage rates to drop, it's not something that you can truly rely on and foresee, especially if demand really starts to pick up. We're going to see home values start rising a decent amount, especially more than it is today because rates have been around 7% for so long. We're seeing a little bit more stickiness with house prices, but just waiting, we're going to wait and see for mortgage rates to drop just a little bit more. And I'm going to be curious to see how they start moving throughout 2025 because it can be a lot different than what I had anticipated in on January 1st of this year. So it's just a matter of how things unfold. But if you can get into the market, go do it. Go strive for that goal. I mean, of course, everyone wants to do it. So be the first to it. That's all I got to say. But thank you,
So wait,
everyone,
I
again.
really
Oh,
quick,
wait.
I wanted to add one more thing because that's interesting because I do think that the that to wait and see what's going to happen is the wrong tack to take because we already have had values going up across the United States with 7% interest rates. Holy cow. Can you imagine when interest rates are cooperating and they're starting to drop, what that does? It's already been a problem. The only caveat to this is thank goodness there are more homeowners coming on the market. And as rates drop further, it will invite more homeowners to come on the market. So that's the balance that we're looking for. So we're just going to have to see, but it's just not a recipe out there for values to cave other than in certain markets, values are coming down. But that's coming off of extreme highs, and they're just giving back some of those real extreme highs. So overall, what are you exactly? What are you waiting for? Values have already gone up at these higher interest rates. As rates fall more, oh boy, I don't know. I wouldn't wait to see what's going to happen with values. That's for sure. It's like that's the thing. You go into a home and you want to go in and you can afford so much of a house. Go purchase and hold on to it for a long period of time. It's fixed over time. Then you're fixed. I can tell you this much rents over time will go up compared to your fixed payment, which will stay the same. So and we've done a lot of analysis, a lot of that stuff. It's just makes my head spin because so many people say that we're just a cheerleader for real estate, but it's just another forced way of saving and investing. And there's some people that say I could do better on Wall Street. Yeah, but you're going to be paying somebody's rent. You might as well be investing in yourself, in your own rent, and at the same time gaining equity over time and having that fixed payment that doesn't go up over time.
Yeah, what we are cheerleaders for are for people to succeed
Right.
with the right data. And like you said, setting the proper expectations, which of course is what we offer. So thank you again, everyone, for tuning in to another episode of Let's Talk Housing. If you want to learn more about what's going on in the real estate industry across Southern California, the Bay Area, Phoenix, Las Vegas, feel free to check out our YouTube or subscribe today at reportsonhousing.com. Of course, please leave us a good review. We'd always appreciate it. More people listening would be absolutely amazing. And if you have any questions at all, feel free to post it to our social media platforms, or you can email me personally at info@reportsonhousing.com. We'll see you very soon and have a fantastic rest of your day. Thank you.